In a world where economic uncertainty looms large, Robert Kiyosaki's recent warning of an impending 2023 market crash has sent shockwaves through financial circles. His concerns about the vulnerability of various markets, the potential impact of hyperinflation, and the consequences of societal trends raise thought-provoking questions about the path ahead. As we navigate a landscape fraught with uncertainty, it's worth pondering whether traditional investment strategies can withstand the impending turbulence, or if there's a need for a fundamental shift in the financial paradigms. Are we prepared to navigate the storm? Or are we clinging to outdated and antiquated investment strategies that are certain to lead to failure? Hi! Allow me to welcome you to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. So make sure to leave a like, subscribe if you're new to our channel, and please click the notification bell. Now, without further ado, let's start. Robert Kiyosaki, a prominent investor, delivered a grim message, announcing a looming economic crisis in 2023. He expressed concern about the impact of this crisis on individuals who might fall victim to the societal trends like wokeism, and what he perceived as market stupidity. He particularly emphasized the vulnerability of various markets, including real estate, stocks, and bonds. He likened the real estate market's downfall to a sinkhole, noting that its decline could drag down businesses and neighborhoods, affecting a wide range of people. In contrast, he mentioned that stock losses, such as Apple's, might not impact those not invested in those specific stocks. He also discussed the phenomenon of people relocating from certain states to others as a response to economic uncertainties. Kiyosaki expressed his favor for investing in oil, highlighting the fact that oil couldn't be printed like stocks or money. He argued that civilization depended on energy, and if energy prices rose or become scarce, it would lead to a decrease in the standard of living. Moreover, Kiyosaki noted how his wealth increased due to the Keystone XL pipeline shutdown after President Biden took office. He explained that oil previously sold at $30 per barrel from wells in North Dakota, Louisiana, and Texas experienced a significant spike in price, reaching $130 per barrel. Kiyosaki continued his dire prediction, drawing parallels between hyperinflation and the rise of dictators like Stalin, Mao, Lenin, and Hitler in the past. He expressed concerns that the current situation could lead to a similar outcome. Hyperinflation, he argued, had the power to agitate people by making it difficult for them to afford basic necessities, causing their lifestyles and standards of living to plummet. Additionally, he attributed much of the problem to the energy crisis and an excessive money supply, both of which contributed to the soaring costs of goods and services. He reiterated his belief that a significant market crash was on the horizon, emphasizing the gravity of the impending downturn. Turning his attention to the average investor, Kiyosaki criticized what he referred to as a buy and hope strategy. He pointed out that many people simply invested in mutual funds and 401k plans and hoped for the best, without a concrete retirement plan. He stressed that hope alone was an inadequate retirement strategy. Many, he noted, had been blindsided by recent losses in their 401k portfolios, with values plummeting by 25% to 30%. Kiyosaki warned that the situation was far from improving and anticipated that things would worsen significantly in the future. Then he highlighted what he saw as the largest yet often overlooked bubble in the financial landscape: corporate credit. He explained that interest rates were consistently lowered to near zero levels during the economic boom. In response, many companies unable to achieve organic growth resorted to borrowing from their own balance sheets. They used this borrowed capital to repurchase their own company stock, effectively inflating the value of their shares. Kiyosaki cited the example of Apple, which had leveraged its credit to buy more of its own stock. However, as Kiyosaki pointed out, the situation had taken a turn for the worse. Stock markets were in decline, and the bond market faced similar challenges. He drew attention to the case of London or England, where the inability to fund defined benefit pensions for retirees became a pressing concern. To address this, they borrowed money at a 0% interest rate to invest in bonds with a 3% yield, hoping to cover pension payments. The problem, he emphasized, was that as interest rates reversed course and dropped, the bond market suffered, posing risks to pension funds. Furthermore, Kiyosaki expressed his reluctance to invest in assets that could be easily printed, comparing them to printable items like toilet paper. This perspective reflected his skepticism about the value of assets that could be artificially manipulated. However, he acknowledged that many individuals lack the financial education and resources required to achieve this status. He found it concerning that the average 401k balance was just $70,000, a sum many people were expected to rely on for retirement at the age of 65, which he considered a profoundly worrying prospect. He continued to express his prediction of a major economic crash in 2023, drawing a parallel with the financial troubles faced by England due to what he perceived as risky financial maneuvering and interest rate manipulation. He cited an example involving a 68-year-old or a 70-year-old individual whose 401k retirement account had suffered significant losses. Kiyosaki shared that he had recently spoken with financial investors who recommended a stay-the-course approach, advocating for long-term investment regardless of market turbulence. He acknowledged that this perspective was prevalent in the financial industry, reassuring investors that historical trends would ultimately lead to recovery. However, Kiyosaki made it clear that, as an entrepreneur, he personally preferred not to invest in paper assets, expressing his mistrust of them, even humorously likening them to toilet paper. He highlighted that paper assets had advantages that he, as a proponent of hard assets, did not possess. He singled out one key advantage: liquidity, the ability to swiftly exit investments using a smartphone, and the flexibility that hard assets often lacked. Despite his reservations about them, Kiyosaki considered this liquidity a critical advantage of paper assets. Additionally, he stressed his long-term commitment to investments alongside Mike Masali, emphasizing the need for careful consideration when choosing where to allocate funds. He reiterated his investment philosophy, which centered on assets that could not be printed, reflecting his preference for tangible and valuable assets. Kiyosaki often found himself excluded from most stock-focused shows because they primarily aimed to promote stock investments. When asked for advice on transitioning from paper assets to his chosen investment path, particularly in the context of oil, he began by explaining the diverse uses of oil in everyday items, ranging from plastics to food and fertilizers. He expressed concerns about impending food shortages and Europe's challenging situation. For the average investor, Kiyosaki recommended diversification by allocating a portion of their income to investments like oil, gas, gold, or silver. He believed that many people recognize the issues with the current administration's policies, particularly when they experience high gas prices and the depletion of national reserves. He explained that the depletion of reserves was driven by two factors: a desire to move away from hydrocarbons and the upcoming midterm elections, where high oil prices were unfavorable. Kiyosaki predicts that after the election, oil extraction from the national reserves would likely resume, causing prices to rise again. He claimed that the government was currently releasing 1 million barrels of oil per day to keep prices low for political reasons, with the intention of advancing the Green New Deal once re-elected. Hi! It looks like you've reached the end of this video. Thank you for watching this far. Please subscribe and give a like if you enjoyed it, and comment your thoughts in the comment section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. See you around!